Welcome to Money for the Rest of Us, a personal finance show on money, how it works, how to invest it, and how to live without worrying about it. I'm your host, David Stein, and today is episode 119. It's titled, Investing Won't Make You Rich. I recently received an email from Casey. Casey's a member of the Money for the Rest of Us Hub, and he owns several commercial printing operations. He started in commercial printing as a janitor out of high school, and he says he took the long route to business success. He worked in a commercial printing warehouse, then production, customer service, sales, middle management, executive management, and then in the spring of 2008, as the great financial crisis hit, he used his home equity and savings to purchase a piece of his boss's printing business. In 2011, he and his partners bought out the founding partner by taking out a $2.5 million Small Business Association loan. Since then, he and his partners have bought two more commercial printing businesses. He writes, quote, "The bottom line is my bank account has swelled in the last couple of years as I've moved from longtime employee to small businessman." Casey asked if he should continue to prioritize small business opportunities or shift capital into investing in traditional financial markets. He and his two partners are looking at some locally based opportunities, including a beauty trade startup, what he calls a chaotic organic coffee company, and an established printing company. Now, that's Casey. I also met a local business operator here in Idaho. He mentioned how he had lost 40% of his investment portfolio in the market crash of 2008. So after that, he got disenchanted with investing, and he went out and he bought a business that sells snow cones at corporate events. He later bought an elderly care center and is looking at potentially buying into a commercial battery operation. He is convinced he can do better buying local businesses than investing in traditional financial markets. I have another friend, Miranda. She's a personal finance writer, and she also owns her own business. She has no employees and writes for numerous clients and works as a brand ambassador. Her business model differs from the commercial printer and the snow cone entrepreneur in that she values the flexibility to travel and work from anywhere. Now, all three of these businesses differ, but they have one thing in common. They all require huge amounts of time to operate. They involve personal commitment and risk to be successful. Owning and running a business is the best way I know to build wealth. Very few people build wealth from investing. Hence the title, You Will Not Get Rich Investing. Even successful investors, such as hedge fund managers, have built the bulk of their wealth not from the actual investment returns, but from the management fees and the 20% cut, what's known as carry, they get of their clients' investment gains. In other words, they built most of their wealth from their investment businesses, not from the actual investing. What is the purpose of the financial markets? It's to preserve wealth, not to grow wealth. And what are we trying to preserve wealth from? From inflation. Preserving wealth means a dollar today will have the same purchasing power as a dollar 10 or 20 years from now. Now, ideally, as savers and investors, we can earn a few percentage points above inflation that will contribute to our wealth, but those few percentage points alone will not build substantial net worth. What builds wealth is having an income stream that is generated in the real economy, either from a business or a profession, and then living below our means so that we can save a large portion of those earnings and profits, and then preserve them by investing in public and private markets. Casey in his email mentioned he doesn't have any type of informational edge to invest in the stock market. And neither do I. And probably either do you. But you don't need a competitive edge to preserve wealth. You just need to understand the math and the emotion of investing. By math, I mean understand the mechanics of what drives asset class returns. How bond returns are primarily driven by current interest rates. How stock returns are driven by dividend yields and corporate profit growth. How real estate returns are driven by rents. In other words, the math of investing involves understanding how a particular security or asset class generates cash flow. Business owners and buyers do the same thing. How does a business generate cash flow? I'm sure that Casey, as he and his partners are looking at these businesses, he's looking at cash flow statements, income statements, trying to figure out how the businesses creates cash flow. Now, the motion of investing is about understanding how investors are valuing those cash flows. When investors put a high value on investment cash flows, bidding up security prices, then subsequent returns will be lower. When investors are fearful and place a low value on an investment's expected cash flow, then subsequent returns will be higher. And this is that third leg when we talked about the math of the drivers of stock returns. We have the dividend yield, we have the corporate profit growth, but then we have the emotion, the price. What are investors valuing those earnings at? And if that price to earnings ratio is high, then the potential return is going to be lower than when the PE ratio, the price to earnings, what investors are buying, what are they paying for dollars of the earnings? When they're low, then the expected returns will be higher. So we have to combine the math with the emotion.